We've already gone from roughly 15 trillion to over 18 trillion just year to date.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
So what's up, guys? Jay Martin here, CEO of Cambridge House, and today I was chatting with Lyn Alden, founder of Lyn Alden Investment Research. Lyn is a macro investor based in the US, and today we talked about the US equities market, gold, silver, copper, Bitcoin. I got her take on the global pandemic and subsequent economic crash. We talked about global debt levels and much, much more. If you enjoy this interview, please hit subscribe. And if you want to hear from me more often, you can always subscribe to my newsletter where I recap conversations like this and plenty more. Just hit the pinned comments right beneath this video or follow me on Twitter @Cambridge. Okay, well, I'm really excited to chat. I need some help making sense of this crazy world, and I hope that you can help me today.
Yeah, I think we all need some help with it.
But I read an article that you wrote just a couple of days ago on your site because you produce a lot of awesome free content, and it was specifically focused on the debt problem, but you drew some really interesting parallels between, call it the 1929 crash and the 30s recession, bookended by the crisis, which was World War II, between, and tying that to today with the 2008 crash, the following recession, bookended by a different kind of crisis, but a global pandemic. So can you touch on that just real quick for our viewers?
Sure. So if you look back to the 1930s and 1940s, the Great Depression, of course, started with the 1929 stock market crash, and then the first several years of the 1930s were this very deflationary crush. And that's because we started that decade with a very high private debt level relative to GDP. So federal debt was pretty low because the government was pretty lean back then, but we had a very large private debt bubble that had built up throughout the 20s. And during the first few years of the 1930s, we had major bank failures. So we actually had a major decline in the broad money supply, which doesn't happen these days. It just goes up at different rates. It never really goes down. But back then they had they lost about a third of their broad money supply because so many banks failed. And so even though there was deleveraging and defaults, debt as a percentage of GDP kept going up. And they eventually, as most viewers probably know, they devalued the dollar compared to the gold peg it was on. So they decreased it from, about 1/20th of an ounce to 1/35th of an ounce of gold per dollar. And that also, they printed tons of money. They did all these infrastructure works. They did all these new entitlement programs that we know today. And so the way that they kind of tried to go out of it is by, instead of decreasing debt, they radically increased the money supply from that point. So if you look at the monetary base from that period, it just skyrockets. It goes vertical. So it's not like a gradual change. It's just like a sharp transition to a new era of how they're doing things. And people might think that's inflationary, right? So, and it was to a certain extent. So we went from deep deflation, like we had like negative 10% inflation, right? And then when they devalued the dollar, it shot up to maybe 5% inflation, right? So we didn't have high levels of inflation. We had a more reflationary environment. But basically, there's so much debt and deleveraging in the system and destruction of capital and destruction of wealth that even though they increased the money supply pretty significantly, we didn't really experience high inflation for that decade. Now, the 1940s, due to the outbreak of World War II and all the spending that was required for that, we had a federal debt bubble. So by then, private debt to GDP had been decreased significantly compared, to where it was. Whereas in the 1940s, federal debt is what ramped up. So we got to over 100% federal debt to GDP, and we were running deficits that rival what we had today. So they were running 20-30% deficits as a percentage of GDP to fund the war. And the way that they resolved that was that the Federal Reserve, they locked treasury yields at 2.5% or below. And they did so by, they didn't call it back then, but it was quantitative easing. They printed dollars and they bought treasuries as needed to maintain that peg.
Right.
And now, so during the 1940s, there were really sharp periods of inflation that briefly even exceeded what we saw later in the 1970s. So we had double-digit inflation in I believe 1942 and 1947. We had these big spikes of inflation, but they still held the Treasury yield at 2.5% or below. And as a result, if you look over the course of that decade, we had this continued rapid increase in the money supply. We had a more inflationary, fiscal heavy, environment. But because they locked yields so low, Treasury yields, even though they made money nominally, they lost money on a real basis. So they underperformed inflation. They underperformed things like silver, real estate, stocks, and so Treasury investors lost money on a real basis throughout that decade, and they essentially inflated away a big chunk of the federal debt as a percentage of GDP. So as they moved forward into the 50s, they really got down that debt level pretty significantly, not by paying it off, but by devaluing the dollar relative to the fixed debts that existed. And so my point now is that the current period, the 2010s really mimicked a lot of what we saw in the 1930s, where we had this rapid increase in the monetary base, but it wasn't a very outright inflationary environment because we had so much private deleveraging. So we had a private debt bubble. We had the housing sector specifically deleverage a bit. But then in the 2020s, it looks like we're kind of more closely mirroring the 1940s, where we have a federal debt bubble. So we started this decade at over 100% of GDP federal debt. Now we're already over 120%. We're running a 20% plus deficit this year as a percentage of GDP. And the Federal Reserve's once again talking about yield curve control, and they are the primary buyer of treasuries. So it's eerie how kind of similar these two periods have been.
Yeah, yeah. And so I understand all that. And as we continue to, I guess, increase the money supply and massively increase the debt to GDP ratio, we're also simultaneously going to be, I guess, decreasing the debt to money supply ratio, which,
Yes.
At the surface makes it look like we're becoming more anti-fragile. But what's your take on that? Less fragile.
Yeah, so the federal government and the Fed, they can't necessarily impact GDP too much because that's most of the private economy transacting. But the thing that they control more is the money supply. So in addition to money supply being created by commercial lending, the federal government, as we saw in this period, they can do things like helicopter checks, extended unemployment benefits. They haven't done it yet, but they could do a big infrastructure bill. Whatever, they could do tax cuts like we saw in 2017, and they could do more tax cuts. So there are various kind of right-leaning or left-leaning things they can do that essentially, gives more money back to the public, but that's not funded by, it's not funded by taxes. It's not funded by people lending. It's funded mainly by them issuing treasuries and the Federal Reserve creating dollars to buy those treasuries through the primary dealers. So unlike what we saw in 2008, that QE back then mostly went to recapitalize banks, and not really much of it spilled out into the broader economy. Whereas in this period, because we have so much aggressive fiscal spending that's being monetized by QE, a lot of that is spilling over into the broader economy. So in the near term, it's not sharply inflationary. It's if anything, we have deflation in discretionary goods, and then some inflation in the more essential areas due to supply chain disruptions and such. But if this continues over the several more years, which is likely considering with people out of work, they're not all going to go back quickly. So we're going to have tax decreases. We're going to have extended spending levels. So it took many years to somewhat normalize after the previous crisis, and this one, by most measures, is far larger. So my view is essentially that we're going to have a faster money supply increase than consensus probably estimates at the moment. We've already gone from roughly 15 trillion to over 18 trillion just year to date. And in the years ahead, I think this is going to continue going up by the trillions because most of this QE and most of this federal spending is spilling out into broader economy, not necessarily equally, but it's getting out there. So if you combine supply disruptions, deglobalization with this rapid increase of debt monetization and fiscal spending, we could be up for a more inflationary environment in the 2020s, similar to what we saw in the 1940s.
So do you think that's possible, that in the 2020s, the US is able to inflate away a substantial part of that debt again?
I think that's what they're going to try. Whether they're successful or not is, matter of debate. They are talking about doing yield curve control. So at their recent FOMC meeting, they talked about yield curve control. They were actually talking about it back in 2019, even before the pandemic. So even before this massive, huge stepwise increase in the federal debt, they were already talking about doing yield curve control. And then now it only got even closer to probably happening. And I would argue that because they're already buying as many treasuries as are issued, essentially, that they're already doing a soft form of yield control as of early 2020. So from their point of view, they have an inflation target of symmetric 2%, right? So, and they if they run cold, if they run at say 1% for a while, they're happy to go up to 2.5 or 3% to kind of, quote, make up for the fact that they ran low for a couple of years. So from their point of view, if they can achieve say 3% inflation while doing yield curve control and capping yields at 1.5%, that's kind of how they probably view a way of managing debt levels, especially for the federal debt.
Got it. Got it. Now, Lynn, I have a question for you. I'm trying to understand why there's often an inverse relationship between increasing the money supply and the velocity of money. You could assume if there's more dollars in circulation, the velocity would increase because there's more borrowing and lending available. But often there's an inverse relationship. Is there not?
There often is because the money supply is a denominator for the velocity calculation. So if you compare GDP to money supply, if you're increasing the money supply very quickly, but the GDP is not increasing as fast, then by definition you're going to get lower velocity, and that's because the amount of money supply that they're doing doesn't necessarily translate into higher productivity and higher kind of core growth. So there's a couple different factors into play there. One is that over the past couple decades, we've had pretty significant wealth concentration. So wealth concentrates, in the top 10% or so, and then especially in the top 1%. So rather than a lot of that money kind of getting around to the broader economy and being spending frequently, it's more hoarded, right? Because I always say as a thought experiment, if you take $1 trillion and distribute it, you give everyone several $1,000 checks to everyone, you'd have a lot of spending at that point because people that don't have a lot of money would be getting this like capital injection. A lot of that would be spent, right? But if you say take that same amount of money and you give a few billionaires each an extra billion, it's not going to change their spending habits, right? They're just going to put it in investments. They're going to save it. Even down just people in the top 5%, top 10%. If you get a capital injection, you don't go out and necessarily spend it. You just kind of save it. You put it in your 401k. You do all this, hoarding. And so because we've had wealth concentration and because we've had other factors like aging demographics, this money supply is growing faster than GDP. So we're by definition, the way that the calculation works, we're seeing much lower velocity. And that's a big reason why we haven't seen broad consumer price inflation because that velocity is not really there.
Okay. So even though we've increased the money supply pretty substantially in just the last like 8 weeks, I think up from like 15 trillion to 18 trillion or something like that, the purchasing power of the US dollar maybe has increased, right? It's definitely held its strength, if not grown stronger relative to almost everything else. Does that surprise you, or is that playing out the way you thought it should or would?
Well, in the beginning of the year, so if you go back a little bit, when we had that repo crisis back in September 2019, I shifted to be a little bit more bearish on the dollar because the U.S. Federal Reserve basically shifted from running tight monetary policy to running a loose monetary policy. So they abruptly shifted from quantitative tightening to quantitative easing, essentially. They didn't want to call it that, but they were doing quantitative easing with T-bills specifically. So from that point all the way up to year end, we saw the dollar weaken from, let's call it 99 on the dollar index to 96 something on the dollar index. Now from early 2020, they stopped increasing their balance sheet. And that was mainly because they were continuing to buy T-bills, but they were leveling off their repo lending, right? So we had, one hand they were taking away and one hand they were still giving. So we had this kind of flat balance sheet for a while. And due to the global dollar shortage, we had a uptrend in the dollar again. And of course that when we had the big giant sell-off in starting in late February and then going into March, we had that dollar spike up to 103. And if you look at it closely, if you break it down, in the very early stage of the crisis, we actually had a dollar decline. It went down to about 95 on the dollar index. It basically, investors flooded into treasuries, yen, things like that. So we had a dollar decline, we had yields go up, yields go down on the treasury, so we had the price go up on treasuries. But then when the dollar shortage started to basically show itself, we had an abrupt reversal. So the dollar shot from, let's call it 95 on the dollar index all the way up to almost 103. And that's when the Federal Reserve had to kick in all of these things like liquidity swaps with other central banks. They did repo lending. They did massive QE to basically flood the system with dollars. And so far, that's been successful. They brought it down from, say, 103 on the dollar index down to, I believe we're under 97 today. That doesn't necessarily mean that was the top or that this is over, but in this current stretch, that whole like deflationary shock of the global shutdown, the decrease in trade, the global dollar shortage that's exacerbated by that shutdown in trade, that's all pushing the dollar up. But then offsetting that is that massive policy response, this multi-trillion-dollar policy response. And so far, that policy response has been large enough to contain the problem. So we've had, it's been a pretty volatile period for the dollar, but it's still largely flat at this point on the year. And going back into late last year, it's been a very choppy sideways pattern essentially.
Mm. And so short term, call it the rest of this year or the next 12 months. Do you think the dollar remains strong relative to other currencies?
So starting in May, I became a little bit more bullish on the euro after having been bearish for a while. So I think in relative terms, we could be in this kind of consolidating pattern for a while. Rather than making predictions about what the dollar is going to do this year, I'm more pointing to the couple of variables to watch. So by the end of July, we have some of these programs expiring for people to get all this like extended unemployment benefits and things like that.
Mm.
So if they start to tighten fiscally, right? So already the Federal Reserve is trying to taper, say, their treasury purchases and their other forms of support. So on some ways they're branching out because they're buying those corporate bonds, but they're also tapering their purchasing of treasuries and they're slowing their rate of balance sheet increases. So they're trying to, in rate of change terms, they're trying to tighten a little bit. And we've also, so early in the year, we saw these really big, like $2.7 trillion or so in fiscal spending by Congress. If we get to the end of July and we don't see another, giant fiscal bill, and we don't see kind of a new program by the Fed, it'd be very easy to have the dollar strengthen again because we would have less of this kind of flood of dollars. Now, if they do yet another fiscal injection, if they do, and that's all monetized by QE, then I think we could see continued decline in the dollar. So it really comes down to watching what they do fiscally and what the Federal Reserve does in terms of monetizing and deficit financing all of those spending packages.
Okay. Now, what's your take on, because you organize your portfolio, or at least research country by country, and there's a significant number of countries that are holding large US dollar debt, and due to the global pandemic, their cash flow has been cut off, GDP is shrinking. Do any stand out as the most vulnerable right now, in the most trouble?
Yeah, so in addition to Argentina, which has been troubled for a while, Turkey's also one of the biggest risk areas because they have very large dollar-denominated debts and low reserves. So that's the main way I look at it, is not just in absolute terms how much dollar-denominated debts they have, it's also how many dollar-denominated assets do they have, right? So some countries have pretty significant dollar debts, but then they also have a hoard of treasuries, which is even larger, right? So they're a little bit more protected. Whereas countries like Argentina, Turkey, Chile, they have, to some extent Indonesia, they have large dollar-denominated debts, but then they don't have a lot of reserves, right? So the countries that have reserves, if push comes to shove, their central bank can sell treasuries, get dollars, and then distribute dollars to their banks, and they can kind of loan them in their system, and they can essentially pay off some of their debts by selling some of their assets, right? So that's what we saw in March. We had that's what triggered the Fed to issue all of these kind of liquidity programs to the foreign sector, is that the foreign sector sold about $250 billion worth of treasuries in a very rapid period of time. The whole treasury market became illiquid. We had that brief spike in yields, and the Federal Reserve began buying $75 billion a day in treasuries to make up for the fact that both the foreign sector and then some hedge funds were selling aggressively, right? So some countries that have a lot of those treasuries are fine, whereas the real trouble spots are these, some of the smaller emerging markets that they have the debts, but then they don't have the assets. So they're totally at the whim of hoping that the dollar weakens or getting financing, getting IMF support, whatever the case may be. Those are the real troubled hotspots.
Right. Now, I want to touch on that. Foreign countries that are holding U.S. Treasuries, how much were the U.S. swap lines inspired by the need to protect the Treasury market?
Entirely. Like, so the Federal Reserve, they actually cited that as the reason. So both they have two main programs for this. One is their liquidity swaps, and then the other one is the international repo. So some central banks have direct lines, so they can do liquidity swaps. And then for countries that don't have that, they can, instead of selling their treasuries on the open market, they can loan their treasuries to the to the Fed, and the Fed gives them dollars, right? So both those programs, they cited the protecting the treasury market as kind of the impetus for that. They also cited it in their meeting minutes. And then the data supports that. So both in when we saw the dollar spike in 2016, for example, when we had this kind of the more recent slowdown before this one, we had the same effect where when the dollar spiked, foreigners sold off treasuries, right? But that was a more contained issue back then. So we had a sharper version of that this time, and it caused the treasury market to become illiquid. So we have this pattern where whenever the dollar spikes, foreigners sell treasuries, and the Federal Reserve is aware of that. So they stated in their press releases and in their meeting minutes, and the data supports that's true. So they're doing it pretty much entirely to protect treasury market as well as other markets. So they don't only own treasuries, they also own corporate bonds, they own stocks, they own US real estate. So the treasuries are the most kind of liquid and official reserves, but then they have these other assets as well that they're trying to protect.
Right. Now, if they're motivated by their need to protect the U.S. Treasury market when they're offering these swap lines, can they also be fairly disciplined or strict with the terms that these countries receive? Does it give them some leverage in any sense, or is it strictly self-serving?
So far, it seems self-serving. Their terms have been pretty loose. They've done over $400 billion in liquidity swaps, plus all the international repo that they've been willing to do. And so far, it's been successful. And they essentially the way of looking at it is that those nations are the creditors to the U.S. So you kind of have to look at it on both angles. On one end, we're bailing them out because we're giving them dollars when they're short on dollars. But on the other hand, they lent money to us. They're our creditors. We're their debtors because they own our treasuries. So we're basically bailing. It's like bailing out your landlord, right? So your landlord doesn't punish you by evicting you. So in order to maintain global reserve status and not have a giant disorderly sell-off that affects the treasury market, that affects all U.S. assets, they have a strong incentive to do it without asking for very sharp demands. And we don't know what the content of the calls were between all the different central banks. We don't know what they discussed behind closed doors. But from what we saw, the terms were pretty loose. They offered more swap lines than they did in the prior crisis. So back in 2008, they opened maybe 6 or 7 swap lines, whereas this time they did more than double. So they did the initial set, but then they also opened more swap lines with some emerging markets and some other countries. So they've been pretty loose with swap lines for any country that's a major country and it's not one of our antagonist countries.
Right. Now, there's maybe, 20 countries that have swap lines presently.
Yeah, something like that, like high teens, I believe.
High teens. Okay. Does that impact your risk assessment, Lyn, when you're looking at various countries to deploy capital? Will you apply preference to countries that have swap lines with the U.S.?
Not significantly, because I look at that's more like a fragile system, right? Because then they're reliant on that external help. So for me, the main, in terms of this particular metric of how dollar exposed they are, for me, the biggest metric is how much reserves they have relative to GDP versus how much dollar-denominated debts they have relative to GDP, right?
Okay.
So that's kind of a more self-contained protective mechanism, whereas the countries that have more debts than reserves, in the shorter term, they're relieved by the liquidity swaps, but they still have like a potential solvency problem that I wouldn't trust that swap line as, kind of a permanent solution. It's kind of a placeholder until global trade picks back up and until, QE kind of weakens the dollar a little bit, gets out of the dollar spike. So
Right.
swap
lines are fixing a liquidity problem, not a solvency problem.
Yeah, so I'd be very careful about relying too heavily on swap lines when it comes to kind of assessing risk in different countries.
Okay, so tell me about your portfolio right now, Lynn. How are you positioned in regards to what you are most concerned about?
Yeah, so the portfolio that I maintain, and we maintain a couple different portfolios for clients to see, but they're quite diversified. So what we do, instead of making very concentrated bets, we have a diversified portfolio, but then we tilt it in different ways based on where we think opportunity and risk are, right? So in the past, since 2018, we've incorporated gold and gold stocks in the portfolio, for example, and that's one of the biggest alpha generators. Uh, then we have U.S. stocks, we have foreign developed stocks, we have international stocks, and I emphasize countries a little bit more heavily that have, this more robust financial situation, right? That have lower dollar-denominated debts, higher reserves. Um, we're very cautious with going in too heavily into countries that are too leveraged, right? So it's globally diversified, but with an emphasis on quality, right? So we also incorporate individual stocks. So we have kind of a filter for stronger balance sheets, companies that produce cash flows, companies that are resistant, that have high returns on invested capital. So it's kind of a value tilt with quality, right? So a lot of value stocks don't have a lot of quality; they have high debts, right? So what we look for is a blend of companies that are, they're not in this big momentum bubble that's been happening of just like people being willing to overpay whatever they can for non-cyclical stocks or stocks that are, have been benefiting from technology trends. We have a lot of companies that have very strong cash flows and that are trading at a cheaper price, but that also have strong balance sheets so they can withstand this whole solvency crisis that's happening.
Got it. So broadly, are you bullish U.S. equities in the near term?
Not particularly, but one thing I'm tracking is the rotation from growth to value. So um, generally during recessions, we have a shift where if you look at the equal weight S&P 500 to the market cap weighted S&P 500, we often have a shift in leadership, right? So uh, towards the end of this period, like in 2019, and then especially it exaggerated itself in early 2020 when we had this pandemic hit and the shutdown. We had record concentration in the S&P 500, right? So at least over the past, 20 years or so. So the top five stocks accounted for 20% of the whole 500 company index because it's weighted by market capitalization. But we're seeing signs of that potentially bottom, right? So the equal weight index, it underperformed early in the year, but it's been building a pretty strong base. And that's actually a pattern we see in prior recessions. So towards the end of a cycle, we often see the market leaders kind of extend their gap over the rest of the index. So we see the market weight outperform the equal weight, whereas that kind of hits ahead, it kind of gets to its widest point, and then we see a reversal where the equal weight starts to outperform and some of the leaders start to lag a little bit. So what concerns me about the broader index is that we could have a rebound in some of the beaten down sectors, but we also could have, lagging from some of the market leaders. So I'm not particularly bullish on the broad equity index, but I am interested in watching this rotation potentially happening. It's not confirmed, but it's a bottoming process of growth over value and momentum, like market weight over equal weight. So I think there's, money to be made potentially in the more equal weighted or value tilted portfolio, uh, assuming we have you know probably more fiscal spending later this year that's going to keep things afloat.
So not necessarily bullish, but not really bearish either. It sounds like.
Yeah, I've been kind of neutral in this period.
Okay. So do you have any predictions on, where the big funds cash flow, if you're managing a large fund, large hedge fund, you have a mandate, you can't go, all to cash. Do you have any assumptions about where that capital will be making what it perceives to be the safest bets in the next year?
It's hard to say. So what they've been doing lately is they've been crowding into those momentum stocks, right? So when they have to buy something, they're like, okay, we'll buy Apple, we'll buy Google, we'll buy Amazon because they're more pandemic resistant businesses. Uh, Going forward, um, so far we're seeing that bottoming trend. So we might see kind of a more contrarian play, people buying banks, people buying industrials. If they think that there's too much concentration, they may start to get alpha by looking into those sectors. And there's early signs of that. It's not confirmed yet, but that kind of breakout might happen.
Right. Okay. So you got into gold, or got back into gold, I should say, in 2018, because I know you were in gold earlier, and I think
Yeah.
you liquidated your gold and or gold stocks in like 2010, 2011.
Yeah.
So what were you seeing in 2018 that inspired you to jump back into precious metals?
For one, it was very low, so they had kind of a pretty big dip that year, and so by long historical standards, they were pretty cheap. And then I do a couple different ratios to compare gold to the money supply, right? So we had money supply continuing to increase even though gold had been in a long bear market consolidation phase. So it got to the point where I considered gold to be, attractively valued. So I wanted to incorporate that back in the portfolio. And then I also, some of the gold stocks, especially the streamers and royalty companies, were very attractive at those levels. So um, the way I viewed it was uh, we were in a situation where if you look at long term, federal debt tends to rise more rapidly during recessions, and it tends to, the deficit tends to widen during recessions and narrow during economic booms. But we were seeing a very unusual period where we were extending the cycle by running larger deficits. So we were actually having a widening deficit even during a bull market, right? So even though it was 2017, 2018, 2019, we were seeing a wider and wider deficit. And so my view was that, we're likely to have QE and debt monetization going forward, and that this would be a pretty good environment, especially when you have overvalued equities, and then you're going to have, a shift from tighter monetary policy to looser monetary policy. I definitely thought that having gold and gold stocks, and to some extent silver in a portfolio was a really good defensive hedge against that type of environment.
Right. So you mentioned gold miners and royalties, I think.
Yeah.
And do you buy physical as well?
Yes.
How do you buy physical? Do you own coins and bars?
Yes.
Got
Yeah,
it.
there's a couple ways. So I kind of have a layered approach because there's different vehicles for different purposes, right? So the physical is kind of the off the grid, kind of insurance holding, right? So then you have coins and bars. It's not the most liquid, it's not the most convenient. Um, and then you can have private vaulting services, or you can have some of these ETFs or exchange traded funds that are, there's some that I don't particularly trust, but there are other ones like I think the Sprott funds are pretty good. They have the physical metal stored. So that's kind of one way to get exposure. And then that's more of a wealth preservation set of investments. It's not really for making money, it's for keeping money. And then the gold stocks and the gold streamers, either through ETFs or through individual stock selection, are more for speculation or for capital growth.
Right. And I think the very last sentence in this article you wrote a few days ago was that you're especially bullish on silver this year.
Yeah, so if you look at in history, during recessions, gold tends to outperform silver because it has that safe haven aspect, and because so gold's almost entirely a monetary metal. It has low industrial use due to its high price, whereas silver is about 50-50 industrial metal and monetary metal. So on one hand, it's used for jewelry and bullion. On the other hand, it's used for industry. And it's also, because it's a mining byproduct, it tends to have very volatile pricing. So the gold silver ratio tends to rise in these more deflationary shock periods or these periods of fear. But then when the rate of change starts to get better. So, you know, let's say if you look back in 2009, 2010, right? So at the bottom of that market, right? So the economy was terrible at that point, but in rate of change terms, it was improving. It was getting less bad, and then
Sure.
it was slowly recovering from a very low base, right? So because we're seeing signs of that now, which is that total unemployment continues to get worse, but initial claims, like the number of jobs lost every week, started very rapidly in March and April. Now it's tapered off, and now we have all of this kind of excessive fiscal and monetary response to try to prop everything up. We're past that more liquidity-driven, massive deflationary shock phase where we had the gold-silver ratio go to something like 120 in the paper markets, right? So now that we're in this kind of ongoing solvency phase and a more reflationary phase potentially, I've been favoring silver a little bit more aggressively than gold. I still have a gold as a higher percentage, but I've been emphasizing silver a little bit more heavily than I had been because I think we're getting closer to an opportunity where silver could continue its period of outperformance.
Right. Right. Okay. So then Can you share your perspective on another industrial metal? What about copper?
So I'm bullish on copper. It's been a rough period for copper due to the COVID-19 issue because we've had that, demand decrease, especially from China.
Mm.
But due to the long-term structural issue where they haven't been really opening mines very much, right? So we don't have a ton of supply coming online, but we do have global demand, gradually increasing over time. Especially, it's heavily used in electric vehicles. It's heavily used in industrialization, right? So India, for example, uses very little copper on a per capita basis. So if they start to urbanize more, if they start to kind of go to the route that China did over the last 10, 20 years, we can see more demand from India for copper. So combined with the fact that there is not a lot of supply coming online, and combined with the fact that currencies, from the dollar to the yen to the euro, they're all kind of devaluing at different rates. They're all rapidly expanding their money supply and rapidly just kind of printing money, um, both from the dollar devaluation, the currency devaluation, and from the supply and demand characteristics of the metal. I am pretty bullish on copper, and copper produces long term.
Okay, awesome. Now, so do you have a position in Bitcoin, Lyn? Do you look at the cryptocurrencies?
Yeah, so since April 2020, I've had a speculative position in Bitcoin long.
Okay, that's super recent. So yeah, there's a lot of big money turning that way right now. What turned your head? Why did you make that call?
Sure. So I've been aware of the space for years, but I first wrote an article about it in 2017, and that's when we had that pretty big bull run in Bitcoin, right? So I started to get tons of emails from people that, what are your thoughts on Bitcoin? It's kind of like that big euphoric phase.
Mm.
And so at the time, Bitcoin was around a little under 7,000. And so I wrote an article where I kind of analyzed it from a couple different points of view, either as a medium of exchange or as a store of value. And I concluded I basically had a neutral and slightly bearish outlook on it, where I didn't I didn't call it a bubble or anything like that, but I also just wasn't interested in adding to it. I considered it speculative. Um, and then so during the past 2.5 years since that article came out, Bitcoin's had a wild ride. It went all the way up to 20,000, then it fell to under 4,000, then it went back up to call it 12,000, went
Mm.
back down during this recent early 2020 liquidity sell-off. It went back down really aggressively. And by April, there's a couple factors that started to improve my outlook on Bitcoin, which was one, we had 2.5 years of Bitcoin continuing to maintain strong market share in the cryptocurrency space, right? So instead of all the coins being diluted, right, we continue to have Bitcoin retain about 2/3 of the market of all cryptocurrencies.
Yep.
So the network effect, after it's been over a decade since it's existed, is proving to be very resilient, right? So you're basically, when you're investing in Bitcoin, partially you're investing in the network effect of that protocol, right? So my view of the network effect of that protocol strengthened over the past 2.5 years since my 2017 article. And then in addition, when you add all of this excess liquidity that's coming online, so you have the Federal Reserve, the ECB, the BOJ, they're all printing aggressively, right? So you have what I thought was probably going to take several years to happen has been compressed into a year, right? Because of the pandemic. So we have a more aggressive fiscal and monetary policy than most people would have guessed last year, right? So
Mhm.
when you combine that excess liquidity with good signs of Bitcoin maintaining its network effect, and then the halving is making supply come online at a slower rate now, there's a pretty good case to make a speculative investment in Bitcoin. So we entered it around April 2020. It was a little under 7,000, and so far it's done pretty well. But it's a very volatile investment.
Yeah, so you still look at it as a speculation though, right? This is not
Yes.
safe haven asset class by any stretch. Okay. And can I ask how you buy, Lyn? Are you allocating your portfolio? Are you allocating tranches, or you establish the position in April and now you're just going to set it and watch?
I did it in two tranches. So I established my main position in April, and if I never bought more from then, I was pretty happy with that position.
Got it.
But then I did add more in June as well. So I'm willing to add kind of smaller tranches if we get dips.
Okay. Okay. Very cool. Okay, Lyn, I'd love to know of a news source that you cannot live without.
I'd have to go with Twitter. Twitter's it comes out faster than pretty much any other news source, and you get basically institutional level research in bits and pieces for free from every different source. So people I agree with, people I disagree with.
Mm,
I have people challenge me so I can kind of strengthen my views. I see their views. I see breaking news faster than I see it on any other news source. So Twitter
mm.
has been a phenomenal news source for the financial community.
Awesome. Love that. Can you name a book that all of my viewers should read this year?
I'd have to go with Ray Dalio's Big Debt Crisis book.
Very
I
cool.
believe he came out with it either, I don't know if it was last year or the year before. And it kind of provides an overview of how long-term debt cycles often come to an end. So it uses historical references and shows kind of on average how they tend to end, both in the U.S. and internationally. So it kind of, if people are curious about how deflationary crises or inflationary crises differ. How come sometimes there's a deflationary crisis? How come sometimes there's an inflationary crisis? That book kind of provides like a lot of detail on that. I found that kind of a useful framework for seeing how these long-term debt cycles and currency devaluations tend to unfold.
Okay, awesome. And are there any personalities, Lyn, that you pay an extra amount of attention to?
Not specifically, but I try to maintain views from all sides, right? So I pay attention to, say, dollar bears, dollar bulls, inflationists, deflationists, mainstream economists, people with alternative views. I try to avoid the echo chamber by just having so many different feelers out there to see what all the different arguments are,
Mm,
all over the place.
got it. Okay, very cool. Now, you've got a lot of great content up at lynalden.com. But if our subscribers are looking for a bit more, where else can they find you?
Yeah, so I'm on Twitter at Lyn Alden Contact. That's kind of my most frequent updating platform. Lynalden.com, I focus on long form research. I also have a free newsletter there that comes out every 6 weeks and has, it's a long form kind of macro newsletter. It also shows a lot of my recent investments or sales. And then I have on that site, I also have a premium service for people that want, deeper dives into individual investments or more frequent long form content.
Got it. And in that premium service, do you open up your portfolio when you're about to make a trade? Do the readers get notified?
Yeah, they get real-time alerts when I make a trade, and also I often share ahead of time. This is what's likely to happen in the coming weeks. These are the investments I'm looking at probably making, and then any sort of real-time indicator, they get that. So my free newsletter, it provides updates, but it's a lag. It's a thing that comes out every 6 weeks, whereas the premium service is more real-time.
Got it. Got it. Okay. Look, thanks so much for chatting today. It was awesome connecting with you.
Yeah, you as well.
Okay, that's a wrap. Thanks so much for watching. If you enjoyed this, please click subscribe, and then in the comments, let me know who you want to hear from next, and I'll go get them.